All right, guys, the biggest buzzword of the year is Bitcoin. And look, guys, if you like Bitcoin at 120,000, then you probably should love it at 60,000. And that's what this episode is about. We're talking to the Mark Newton, the global head of technical strategy at Fundstrat Global Advisors, and he's breaking it down. We're going to get a price target when it comes to Bitcoin and Ethereum. We're talking about options trading. And more importantly, we're talking about how to make you a better trader. Financial Freestyle starts now. So Mark Newton, man, I'm extremely happy that you're here. Thanks for being able to come and give us all some game, right? And let's cut right to it, right? The biggest headline right now is Bitcoin, right? Everybody's like, is this actually a store of value? We're seeing gold and silver trade at all-time highs. Stripping out all the noise, let's talk portfolio construction. Long-term portfolio, obviously you're a trader. What percentage of your portfolio would you recommend for a person that's 20? Well, no, we'll say 30 versus a person that's 50. What crypto would you have allocated to crypto?
I mean, I personally would say, 10 to 20%, honestly, should be allocated in crypto for long term. I think that makes a lot of sense. And I think the older you get, you have to get a little bit more conservative. But if you're catching something at the right time of the cycle, and I think, for those that are new and all of a sudden it's down 50, 60, 70%, then you might want to also consider those percentages if you're over 50 or at 50. I think that if these days people are living longer and longer, the cycles tend to repeat, over and over again. So you use an 80-week cycle, you can certainly fine tune your purchase and have exposure. So there's no,
Nice.
It's just my own rule of thumb. There's no easy answer to that, but obviously, if you need the money anytime in the future, then you really have to keep that crypto exposure to a very small level, because obviously it's much more volatile than almost everything.
Yeah. Nothing's funnier than when I tell my mom, hey, you should get a little crypto. And then she says, wait, why hasn't it moved? Like, Ma, actually did move. You just, you weren't looking at it when it was at 120.
Right.
Now it's back at 60
Right.
and it's,
Well,
so
yeah. And
which
that's
is
tricky
hilarious.
to have to explain to somebody that they're still right and owning it, but it's just real volatile, and people don't take kindly to losing 50%. So it's
I always laugh at it as like anytime we have, kind of the everyday investor starting to talk about Bitcoin, that's kind of the time where it's like, okay, let me take some gains off right now, right? But the greatest saying is like, buy the dip. But what happens when the dip keeps dipping, right? And so clearly, call it 4 months ago, we saw Bitcoin at 120,000.
right.
Now we're in the 60,000s, right? And so
Right.
as a technical guy, what's generally your buy sign? What should our audience be looking at? If we were to have a general rule of principle, what would you say is generally speaking a good buy zone for crypto?
Yeah, I
And then
think
we can
it's
look at
really
stocks.
important. It's really important to differentiate oneself and really understand your own personality and your trading style, because there are a lot of people out there that are very short-term in nature, and they don't necessarily care about long-term trends. They want to know what's going to happen in the next week. And so when I say short-term, there are short-term traders. There are ones that are more intermediate term. They don't care about day trading, and the long term, they care about the bigger swings, whereas a peaking and troughing and what should I expect in the months to come. And then those are just, the long-term hodlers, so to speak, that really just care about the long-term trends. And they don't ever get spooked out of their crypto holdings when things fall. They just look to continue to buy dips, knowing that in the long term, hopefully it can be higher. So, there's different kinds of indicators, obviously, that fit all those different trading styles, and it's tough to, speak about all those today. I think that in general, using long-term indicators of momentum, such as MACD, moving average convergence divergence, is quite important because it helps you understand the trend. And, I also make use of a lot of trend lines in my own work, and so I look for intermediate term trends, and when those are broken, we did see evidence of that, of course, last October. So those, that would have obeyed, a mechanical system like that could have actually gotten out with minimal losses before the larger sell-off started. But I myself utilize sort of a toolbox of probably 10 different things that include sentiment, counter trend indicators by Tom DeMark. I use a lot of cycles that I develop, and I sort of figure out what has worked very, very well in the past. There's no guarantee it'll always work, but at least helps me to identify, times where crypto can peak and trough, and really, everybody wants to know, is this the bottom or not? We've had a pretty healthy bounce in the last few days. And so I think a lot of people want to understand, did we in fact put in a bottom in Bitcoin at 60,000 and Ethereum right near 1750? Those are targets of mine back towards the beginning of the year, but I did not suspect it would happen in February. I thought that would be hit back in May, honestly. And so, no easy holy grail, I guess, for any of your viewers or listeners. I think it's important just to understand what the trends are, understand what the sentiment is. Those are, in my view, far more important in helping you pick tops and bottoms than thinking you have any sort of handle on, what's happening with those that are building the infrastructure, and the institutional participation and the market size liquidity obviously are far, far bigger now than they were back during the old wild, wild west in the old days. But yet we know the volatility remains. And so, it is important to use technicals. Fundamentals will only get you so far. And when things turn against you, it's a very emotional time when you have to do a lot of soul searching and realize that, first of all, you're wrong. And are you going to continue to buy dips? Are you going to sell lower than where you bought? And then if it turns back up and you feel awful. And so it's a very, very volatile asset class that obviously demands, some real study with regards to fine tuning one's own trend following tools and trying to use that.
So let's actually just look at Bitcoin, right?
Yeah.
I didn't think it was going to go below 70. You said that your view was that you came into the year saying it would probably hit 60K, right? So now we're around 69,000. Is there a point that you would recommend, okay, from a sentiment standpoint, right? And if we're looking at a fear greed index type of thing,
Right.
for crypto only, here's the point that if it gets over 70x thousand, or here's a time where I
Right.
will recommend mom and pops getting in and holding long term. Like what's that
Right.
number?
Well, I think if you're long term, you can get in now. I think sentiment is clearly flashing a green light, meaning it's gotten so negative. It's very fearful that one can buy and hold for the long term. My thinking is that we have a pretty decent rally in crypto that starts right towards the middle of this year and lasts into 2028. So that's my longer term cycle. It does show crypto bottoming actually in the first half. However, I can't say with a lot of certainty that, the lows are in. I think there's a low that has been made, and it was made last week. And my honest, analysis projections call for Bitcoin actually to rally over the next couple weeks and get up to potentially, 79 to 80,000. And thereafter, I think we're actually going to fall and take out the lows into April, May. And so, as to whether you get in, I guess, sentiment would say yes. Trend wise and momentum wise, trends are still very negative. And so for people that care about getting in and immediately, having your face ripped off, so to speak, I mean, it's still going to be a very dicey time, I think, over the next few months. So you have to, unless you're a very rapid trader and could identify and use technicals to tell you, first of all, when the rally is starting, and I think that time is now, or when to exit, which I think is going to be within a couple weeks, and then really get out for probably 2 months. It's going to prove to be pretty tough.
And so when we start thinking about the trend as your friend and when it actually step in, right? Your number one indicator is MACD. And so now I want to even apply that to a different sector, that being software companies, right?
Yeah.
There was over the past few weeks or over the past couple months, software's been getting killed because they
Yeah.
believe that AI, from a business standpoint, people think that they might be able to get a cheaper alternative by actually using AI to replace certain software. But from a trend standpoint, or better yet, how do you step in and catch a falling knife? what is your MACD? Because I also want to get a sense of how you set up your MACD, but more importantly, like what is from a overall standpoint is now a good buy zone for, kind of the overall software space.
I would argue that in a short term, meaning probably the next month, that we do see a rally in software. I would not think that that means it's time to buy a lot of these stocks. I look at longer term trends of how software has fallen so dramatically versus the larger technology space. And I have charts that go back 15 to 20 years where you look at equal weighted ratios of, how does software look versus tech? And it's broken down under levels that we haven't seen since 2007, 2008. So unfortunately, I think there is more pain to come from software. I know a lot of people are trying to be cute and think they found the exact bottom. I don't doubt that we can bounce, but I honestly, when trends get this negative, I think you have to pay attention. And as I told you right from the beginning of the interview, I don't think it's wise to buy extreme weakness. In this case, look, IGV, which is the ETF for the software, North American Tech Software iShares, did pull back and almost exactly touch a long-term trend going from 2022, undercutting the lows that we saw last April, and that hit right around the low 80s. Now, we did get briefly below that, and now we're right back above. And honestly, this looks to have held for now. So yeah, short-term trends are very negative, very bearish, and that started last summer. But the larger trend is arguably a lot more favorable. And so really is important to also, determine your time frame. Do you want to make money over the next month or the next year? I would say in general, it's fine to buy for a dip and a bounce, but I think that the bigger trend, momentum has gotten so negative. I think it's unfortunately, we're going to see a rotation, I think, out of software, probably into semiconductors next, which might start in March. And technology is due for some consolidation, no matter how great the AI story is. This is not only a midterm election year, but we're also having a change in Fed governorship, and we can speak about that if you want. But normally those years are not kind for the markets.
Realistically, you're saying like this is just a bear market rally, right? Where effectively you get in Bitcoin now, you can ride it from 60 to 70. I don't see it going from 70 to 90 over the next few months. It might just kind of trade range bound. How are you able to determine the difference in it bottomed versus actually it didn't necessarily bottom? We're going to trade sideways. Can you educate the audience on how you yourself are seeing something like that transpire? You see, I got my phone out. I'm about to write this down.
I always use cycles in my work. I do some of my own, and the one that works very, very well for Bitcoin is just using not only an 80-day cycle, but also an 80-week, which tends to work very, very well. For the stock market, we have, a cycle that lasts about 180 weeks or about 3.5 years. And so it last peaked in late 2021 and bottomed and went up. And now it's honestly showing a downward progression for this year that should end right around October. The bottom line is cycles are very important. They almost always work for reasons that people don't necessarily always understand, that have little to do with fundamentals. The second is that I'll use, DeMark indicators are a great contrary tool that I utilize in my work, where it as a trend follower, when things are falling, they'll give you buy signals, and when they're rising, they'll give you sell signals. And so I think that's a great tool to also use for those that look at the world like I do. The third is I make use of Elliott wave analysis, honestly. And so I have a couple different, ways of looking at the market that are probably a little esoteric and unorthodox maybe to some. But it really all comes down to trend following. And if we see, evidence of sentiment getting really, really washed out, and then we see a big reversal and volume is very high, then, volume analysis would tell you that potentially there is a, possible low being made. But, as long as trends are so sharply negative, it's always difficult to know that you found a true bottom, or if it's just a bottom, you can rally. And I think the key comes from, first of all, becoming proficient enough with the skills that you have and technicals to sort of understand volume analysis, price analysis when things carve out, reversal patterns after having been down a substantial number of days or weeks. And that's first and foremost. And then if you can mirror that with sentiment, with DeMark, with cycles, it'll put you far ahead of the game. And you notice that I haven't talked at all about, the Fed or earnings or the economy, because honestly, none of that matters.
When you look at kind of the kids that started trading kind of during COVID, and you look, a few years later, they've all blown up their accounts. Let's talk about risk management, right? I think, it's risk management is a lot different when you are managing institutional capital versus kind of mom and pop investors, but I would imagine you probably look at it similar. But talk about risk management and how people that are watching this should think about that.
Well, initially, I would say it's probably prudent not to ever put more than, 1 or 2% of your total capital in any one idea initially. I think as you learn more and you get more comfortable with how to take losses properly when you're wrong, then you can increase that to 5% or 10% or, whatever your own risk tolerance is. But, you have to approach any sort of trade or investment with, these are the reasons why I like it. I think it's going to go here. If it goes here, then I'm definitely wrong. And so you always want to approach something with a fair degree of skepticism that even if the idea is going to be right in the long term, that are you sure that you're timing it correctly and that now's the time to buy? And so, because you don't want to get caught in something where, let's say you bought Palantir at $200 and now it's 140. So yeah, amazing, wonderful, great company, but you're clearly wrong, obviously, in your investment. So do you buy more here? And if so, where are you right or wrong on that? Let's look over the last 100 years of all the things that have moved up 3, 4, 500% or more. What was the one thing that they all had in common before they made that move? It wasn't earnings. It was that the stock moved back. They moved up to new all-time highs before they made that big move. And so let's say if Amazon had a price of 30 and it traded near 20 or whatever for a dozen years, and then all of a sudden it goes and it breaks that level at 30, well, that would be a time that if you were using that kind of approach, you could say, something is changing about this company, and maybe even Wall Street doesn't understand it. But technically, it's starting to act well, momentum's kicking in, and I'm going to commit money to it, or I'm going to add to my position as it hits new all-time highs. You look back at the different factors of the market over the last 20 years, and momentum has clearly been the number one factor by a long shot. And there's been people that have written all sorts of papers about that. So it's not about you're always buying the highest high and just not doing anything, but you have to aggressively manage your portfolio. And when things start to fall out of favor, then you have to know to get out of them. Risk management is all just about, honestly, getting yourself to be comfortable with the idea of selling something and taking a loss. And, if you're right, that's great. Let's say you start off investing and for a year you're right and you can't lose. Well, your bull markets create a lot of geniuses. But honestly, when things finally start to turn, that's when you figure out what you're really made of and who you are on the inside. Because it's how you manage your gains and also your losses, what's going to determine whether you're going to be profitable and successful in the long run. Far too many people are lazy and don't put in the time. And that's the number one thing is you have to understand trends, understand why it is that you made money. And if things had gone the other way, what would you do? Would you buy more? And I would say the answer is normally no. I would get out and I would reevaluate, let yourself sleep at night, keep the emotions low. You can't do anything well if you're angry or upset or frustrated. Normally you compound the problem and end up making a lot more mistakes. So that's my 2 cents.
I love it, right? And here's the thing in this world where we have increasingly more people trying to trade, where some are looking at this synonymous with gambling, right? Where we get everybody doing predictive markets, sports gambling, and now young kids are trading options. And I love your philosophy because at the end of the day, right, the history statistics are going to say a person that just buys a ETF, a passive investment, right? is going to outperform about 80% of the day traders. However, clearly you're in the camp of having an edge. And so I what do you say to someone that's like, look, I think a long-term trader, you can't time the market, they're going to do better than the day trader.
It's a catchy phrase, but honestly, those people are all wrong. You certainly can time markets. I'm testament to that can work and does work. Long-term buy and hold is simply a lazy way out. Let's say you bought Ford at 50 and then it goes and trades in the teens for years. And is that truly better than somebody's buying as a trader? Stocks are hitting new highs every day and getting out of them when they go against them. It's like, I don't know that I would always believe that. I think it's the people that are more disciplined can make money over those that think they can just, be the next Warren Buffett and buy pinball machines and airlines and think that they're, all of a sudden going to be the next value investor and make a lot of money. Honestly, if you want an improved system over a buy and hold, it's utilizing MACD strategy that they teach you how to do in Stock Traders Almanac, where you sell in May and go away, and you avoid the market between May and October every year when MACD turns negative. And if you do that, you've made an order of at least 5 times what the buy and hold people have done over the beginning of time. They have a table that you can pass on. My buddy, Hirsch, he followed in his old man's footsteps, Yale Hirsch, and still comes out with that every day. And they have a pretty interesting table in there that shows you this is what the buy and hold crowd did since 1950. This is what you do, just this one timing tool of getting out in May and getting back in October when things start to turn back up. And it substantially improves the buy and hold. As for trading options, 95% of the people that trade options have zero idea what they're doing. They don't understand the concept of theta or time decay. When I was trading, when you have 3/8, 3/4, and I'm in a pit trading equity options. He eats, he orders. And then all of a sudden it went to fractions. We used to be able to figure out the price of call spreads and the put based on the call, and everything was already done just based on one option and the price of the board. We knew immediately if you're getting a good value or not based on the implied volatility. And now it's just a gamble. Somebody thinks something's going to go up. They hear a rumor, they'll buy out of the money calls. And if they win, they think, well, I guess I did a good job. But it's honestly, the concept of time decay, theta, is the biggest thing that you have to grapple with when you're an option buyer. And that you have to be right away when you buy it, because you can lose 2 ways out of 3. If it goes down or if it goes sideways, you'll lose both times. You have to be right and be right away. So I think that, understanding option theory is really, really important. Always approach things with discipline, with a strategy, not just, being gung-ho and wild and maybe trading above your limits, putting all your money in one basket. I think it's really risky for new people to do that.
Well, it's been a phenomenal conversation. Ladies and gentlemen, the Mark Newton. And that's it for this episode, ladies and gentlemen. Make sure you like, subscribe, and as always, tune in each and every week to Financial Freestyle here on Yahoo Finance. I'm your boy, Ross Mack. Take care.
This content was not intended to be financial advice and should not be used as a substitute for professional financial services.